Hi everyone, and thanks for joining us for today's webinar. Just a little bit of housekeeping. I have muted all of your microphones just to ensure that we don't have any background noise or feedback. We will have time for questions at the end, so please use the chat function to send us through your questions, and you can find this at the bottom of your Zoom screen. I'm now going to hand over to Dan, who's going to run today's webinar. Over to you, Dan.
Thanks, Kirsty. Hello, everyone. My name is Dan Hewitt. I'm a director at Financial Framework, a financial advisory practice. And today I'm just going to be giving some of my thoughts and views around what's been happening in the investment markets in relation to this COVID-19 pandemic. Of course, the advice I'll be giving is general in nature. Please keep it in mind in the context of your own affairs, and if you've got any questions, please go and see a personal financial advisor for more information or advice. So let's get started. I guess going on to the agenda is really stepping through a few different items. The first one being setting the scene about where we were pre coronavirus and how the world looked back then. Wasn't that long ago. It feels like a long time ago though. Then of course what happened during as it unfolded, what happened both in the real world and on the markets. Then really looking forward, which is the most important thing. It's always good to look back, but much more important is what does the way forward look like. We'll touch on some of the government measures to ease the impact economically and what that means both in practice but also for the markets. And I can give you some general advice around that, although I would encourage everyone to run any particular details or questions they might have with their accountants, because it's probably more going to be an accounting ATO driven type thing. And then, of course, if there are any questions, we will be happy to take them at the end. So here we go. Where have we come from? February 2020. Well, what was it, 5 or 6 weeks ago? I just said to someone just a moment ago, I can't believe how long ago that feels, but it wasn't that long ago. So before the world really came to grips with the coronavirus and what was happening out there in the real world and on the markets, amazingly, most respected financial commentators thought that 2020 was going to be a relatively good year on the markets, would you believe? There was nothing, world interest rate environment very low, everyone's forecast economic growth relatively stable. We went to a seminar with one of Australia's leading global investors who stated in early February he thought that the markets were relatively good value in this context of a very low interest rate environment. And what that means is, I guess from an investing perspective, that you don't invest in a vacuum. Now, interest rates very much drive the thinking about valuations, because interest rates dictate what the banks will pay to leave your money in the bank, also what it costs to borrow money. So if you are only getting 1 to 1.5% by leaving your money in the bank, you are effectively in a negative investment return environment if inflation is more than that, which it typically is. So of course, you need to look where you can generate higher returns. So what it does is it forces investors to look beyond the banks and term deposits. And of course, what that means, that drives investment, drives people looking to invest into reasonable businesses that have good long-term prospects. It also means for businesses that they can fund growth in a very affordable fashion. They can basically borrow money for next to nothing to grow their businesses, invest in their businesses. So in the context of that environment, most smart investors around the world felt like, even though the markets from a historic perspective were, we'd been through a fairly long, slow bull market, that the world was still relatively well placed. So what happened? Well, basically the coronavirus happened. It's been described as a black swan event, something completely from left field that no one could have expected. And that's basically what happened. So in late last year, the virus played out to a large extent behind the closed curtains in China, and then it's spread from there. And the world really picked up on it and got more across the impact of it in middle of February. And it probably did take everyone by a little bit by surprise, because even when we learnt about it, we thought that it was going to be relatively minimal, the effect from an economic perspective. And that's all I'm talking about today, is the economics, not the human aspect, which is of course very tragic and a different topic. I'm really looking at it from an investment and markets point of view. Humans like to compare things to previous events. So for me personally, the first thing I thought about was, is this like SARS, where I was a young lawyer in a Chinese focused legal practice back when SARS happened, and and I remember it vividly. It was a significant event, but it was localized really to Asia. It didn't have a large impact in travel in Australia, and it washed through the markets relatively quickly. It still had a significant impact, but it was relatively brief. And I think that's what most of us thought this was going to be. And of course, within a week or two, we realised, because of the infection rate, it was far more significant. And so as that uncertainty and fear and magnitude of what was happening, so the markets corrected very, very swiftly and very, very significantly. That happened, as you can see on these two charts, the middle of February and through March, and really towards the end of March. And you can look, if you see down the bottom, you can see the volumes as well. The volumes dictates activity, and by March, huge sums of volatility. So it did take a little while for the world and the markets to twig onto this pandemic and the economic fallout, but certainly by late February and into March, the impact was well and truly registered on the world markets. It's the quickest, most significant bear market correction in history. It's the most significant correction since 1987. You're talking 40+% from the top to the bottom. To give you an idea in numbers, the ASX dropped from the index from about 7,200 in early mid-March down to about 4,500 was the bottom a week or two ago, maybe 2 or 3 weeks ago. So, and it just happened so rapidly as well. So it really was just unbelievable. And the volatility within those numbers, you know, you had multiple days of swings of 10, 15% in one day, even 20% from top to bottom in one day. So what that means is that the world, and in the Australian context, had twigged to how serious, how significant, how severe the effect of the virus was going to be economically. And then you get the emotion, the human emotion of the uncertainty and how bad it's going to be swinging the markets. So, yeah, just been an unbelievable turbulent period. And it's been like that throughout all the major markets. The whole world is in something like this and it's really another way to think about it is it's like, in a way, the reverse of the GFC, where the GFC was felt in the financial markets, in that sort of virtual world of money and central banks and liquidity and then washed through into the real world where people lost jobs and banks and businesses closed, etc. This has been the reverse. This has very much been felt on Main Street in the real world and then flowed backwards into the economy and businesses. And everything's interlinked. All the all the businesses of aeroplanes and tourism and all these types of businesses are all interlinked around the world. So this stopping of human activity by having to stay home has meant that all these businesses that are connected to human activity are basically it's just overnight stopped, like restaurants, bars, gyms, sport. I mean, it's just been unbelievable. So, and we all know this because we're all living through it. So that sort of sets the scene, hopefully, in terms of where we were in January, early February, what we thought was going to play out for the year. We all knew we were in the tail end of a long bull run, if you like. But as I say, I think everyone thought it was going to be a relatively benign year of mild positivity until this event happened. We've just been through this extreme turbulence and a massive correction or revaluing of the market based on what we're currently living through. And most importantly is what is going to happen next. And what have I been talking to clients about? Well, the short answer is we don't know. No one knows with any certainty what's going to happen. Certainly in the coming weeks and months, we don't know if we're going to be locked down for 2 weeks, 2 months, 6 months. We're not sure. And the longer it plays out in the real world of us having to stay home and not generate economic activity, the worse it's going to be for our economy and the stock markets, which are basically the supermarket of our economy, giving us valuations on all our businesses at any given moment in time. But it's not all doom and gloom. It's certainly in this current phase of not knowing the way forward, it feels very uncertain. People are very nervous about doing anything. But the reality is, if you can take a slightly longer view on things, the world looks a lot better, and you can, with a fair bit of certainty, predict what will happen. So when I talk to clients about, well, what does this mean in terms of investing, or what you should be doing, either putting money into the market or keeping money that's already there is look out 12 or 18 months, 1 to 2 years. For people who have a shorter investment horizon, so let's say you came to me and said, I'd like to invest in the stock market, but I need the money back in 6 months' time. That's a harder question, because no one with any real confidence can possibly say, well, I think the market will have recovered, or we will be through this virus in 6 months' time. I just don't think anyone has any certainty or any level of ability to predict to that degree of detail. But longer term, we're looking at a graph of all the things that have happened in only the last 12 years, inclusive of the GFC. But even if you go further back, right back to the stock market crash of the 20s, the depression in the 30s, world wars, cold wars, booms and busts, the 87 crash, the tech wreck of the 2000s, the GFCs, which is where our chart starts in 2008 is when the GFC started. There are always going to be peaks and troughs. There's always going to be periods of uninterrupted positivity and growth, mixed with events that people didn't see happening, and the market corrects. Human behaviour does have a fair impact on how things roll out in the economic world, on the markets. And what you tend to find is that you have slow, steady, incremental growth, and then sharp pullbacks, and it really depends on the severity of the event as to how, and also how much uninterrupted growth you've had as to how big these numbers are. So you can see with the GFC, it was huge. We had this huge period of growth through China, growing the world economy, and overinflated assets throughout the world, and high periods of speculation. It started with the subprime lending books in America, and derivatives, which create leverage. So everything was leveraged right up, and then once the music stopped, it deleveraged significantly through the GFC. The decks are cleared, and we start again from 09 onwards. And you can see on the chart from 09 to 19, it was what people called like the 10-year bull market. Doesn't mean it was a straight line. As you can see, there were lots of peaks and troughs, but over the last decade, it's been relatively smooth sailing from an investment point of view. So even though completely unexpected black swan event, probably not in the context of 10 years unexpected that there would be a pullback. We just didn't know what it was going to cause it, and here we are. So what does that mean? Where do we go to from here? Well, if you look at the chart for the previous 10 or 12 years, and you think about it even longer, what you know is that the world will move on. The world will recover, and we will continue. The markets will recover. We don't know how long, we don't know how fast, but they will, and over time, money invested will grow. What we do know is if you find this turbulence too much to take, or you're too fearful, or you don't have the risk appetite, or you don't have the investment horizon to ride this out, that if you go sell now, that is basically the worst thing you can do, because you are selling out basically at the bottom, arguably. Now, I'm not saying it's the bottom right today at this point in time, but we are certainly in the middle of a major correction. So at some point in time over the coming weeks and months, we will find a bottom, or we'll be close to the bottom, and the world will reset. This chart's talking about the importance of staying investment in the long-term view. Everyone knows a story, and certainly as advisors, we come across them, of people who lost their nerve and went to cash post the GFC, and then stayed in cash for a period of time. Now, this chart's showing what if you'd stayed in cash for 1 year. I know of people who've stayed in cash for 5 years and 10 years. The problem with that is the opportunity cost is huge. Not only have you lost significant sums of money through going down the crash or the correction, but you've also lost any potential recovery gains. And then the question becomes, in terms of trying to time things, well, when should I put my money in the market? And ironically, the time that most people think about doing it is after long periods of positivity, when people start to feel comfortable, which is actually probably the more dangerous time, because we know that after long periods of positivity, there's often a correction. So my advice to clients, and the advice we get from our managers who manage the investment portfolios that we put forward to our clients, is you cannot time the market. You have to stay invested. You have to ride it out, and you have to think long term. The market is a future viewing machine. It is thinking about what's going to happen in the next years. What's happening right now to the market is irrelevant. It doesn't. Having said that, it does. When there's periods of major uncertainty, it does get quite inward looking. But the reality is, what a company is worth on the stock exchange is not what it makes in the next month or the next 6 months or the next 12 months. It's what does it make? What is a company worth? Well, it's worth what it makes in a typical future year in perpetuity. So you cannot value a business on the stock exchange based on earnings over a period where there's a significant one-off event like a pandemic. To give you an example, airlines, Qantas, for instance. Now, Qantas in a typical year, even though it's a cyclical business, will earn X dollars. The reality is in the next 6 to 12 months, it will probably earn nothing. It'll lose money. The question is it worth zero or negative money? Well, no, it's worth what in a typical environment it would generate in annual earnings multiplied by a factor of, depending on what you think is a fair thing, somewhere between 15 times the earnings. But the question is, will it recover? This is the main question that people need to keep in mind when they're investing in individual stocks, as our fund managers do. Will Qantas and other businesses be adequately funded to get through to the recovery? Can you afford to ground your fleet for 6 months' time or 12 months' time and then participate in the eventual recovery when people start travelling again? And these are all the questions for every single business listed on each exchange, and I'm thinking about the Australian Stock Exchange here. And it's really quite interesting because when you actually drill down into individual stocks, even though the market has corrected significantly, it's quite varied depending on which company you're looking at as to what's happened to the share price. And again, this is a time where being invested with active fund managers, very intelligent people who invest in businesses on the stock exchange based on their value versus just chucking your money in an index and just watching it gyrate with the overall market. Individual stocks here, it's never been more important to think about the individual business and the value of that business when you're investing in the stock market. And so that we are, as a business, for instance, we use a lot of active management, and it's times like these that we really appreciate what they do. To give you an idea, for instance, we know of all the businesses that the stock prices have gone backwards. Flight Centre's a classic one. Qantas, Virgin may very well not survive this, but there are businesses that have gone up dramatically in value. Metcash, for instance, which is the IGA network, they're up about 30 or 40%, unbelievably, because we all know everyone's been, buying 12 months worth of groceries to fund them through, so that if they have to sit at home for months at a time, they don't have to go to the shops as much. Does that mean that the supermarkets are worth more money at this point in time? Well, maybe at this point in time, but is this going to happen next year and the year after and the year after? No. So why would you pay 30 or 40% more for a Coles, Woolworths or Metcash share when you know this isn't going to happen year in, year out over the coming years? It's a one-off event, completely separate to their own business. So if I'm looking at that, I'm saying, well, I wouldn't necessarily buy supermarket shares, but if you're investing in an index, that's exactly what you're doing. You're buying more supermarket shares because everyone's flocking to buying supermarket shares. To give you another example of why that's not a good idea, Wesfarmers, who a lot of people will know is a very smartly run conglomerate based on the stock exchange and very well known in our part of the world, in Western Australia, they are selling their last remaining interest in Coles. It's actually the smart money's leaving the supermarket saying, well, I think it's probably overvalued because people are investing in it because everyone's buying groceries at the moment, but that's not going to happen forever. So the question is finding good value stocks that are being beaten up at the moment, that have the financial strength to go through this period of uncertainty or not earning money or losing money, but coming out the other side, they will recover and be in a normal environment earning what they normally earn. So well-capitalised retail stocks, even for the brave, well-capitalised travel stocks, etc. That's not my job. I outsource that, or our business outsource that to the expert active fund managers that do that on our behalf. But we know in our discussions with them, that's exactly what they're thinking about. Can they get through the next 6 to 12 months? Are they good value in a normal, longer term environment? And that's the idea about long-term investing. So just moving on to how the government's been handling this from an economic point of view. And I have to say, I think they've been doing a good job. And how that's played out both in the real world and also on the stock market. I won't go into too much of the detail around these things because there's plenty of information online, and also I'd encourage anyone listening to this to talk to their accountants, particularly if you run a business, about the detail. But basically, the government's been talking about building a bridge, and that is getting businesses and home people or everyday people across this period where we're all being asked to stay at home and not go about our everyday lives. So they want to build an economic bridge from not being able to work, not being able to run a business, through to once the virus is contained, controlled, and we can go back to some semblance of normality in everyday life. They want to help fund us through this period. So how are they doing it? Well, as you can see on this slide, there's a few bits and pieces. The main one is the job keeper payment. So what they're trying to get business to do is keep staff on. Now, we're seeing headlines every single day of all kinds of businesses having to stand staff down. People reduce hours, reduce pay. But what the government has said is, if you're a business that's been significantly affected on the revenue front by this period of time, and I think from memory, but just need to double check it, if you're not a mega business, so one that's got revenue of less than $1 billion, I think it's either 20 or 30% down on typical environment, then you can avail yourself of this JobKeeper payment, which is basically allows you to keep paying your staff a basic, it's actually an average wage of $1,500 per pay period, and keep these people on the books. Now, for some businesses, you still won't be able to, necessarily put them to work because the business is closed or whatever, but at least you can keep them on the books. And then when you're allowed to reopen the business or get back to some kind of normality, you're going to more quickly recover as people start their economic activity. Just talking about the flow of credit and the banking sector as well. Another really key thing to know is, and this is quite interesting as well, given it's almost, again, it's the reverse of the GFC. The banks have a huge role to play in getting our community through this environment, and I believe that they are very much philosophically on board for this, both reputationally, they've come out of a Royal Commission, but also we're all in this together. So banks have been very quick to contact businesses and basically defer any existing loan facilities. You don't have to, they'll just basically stop the requirement to continue paying principal and interest. My understanding is you'll still have to pay the interest, it'll just accrue at the back end. That basically means if you're used to having to pay a monthly payment to a loan, that will be deferred for 6 months, and they're basically allowing that pretty efficiently without a great deal of information required. That's also happening for home owners as well. You just need to contact your bank. They're also, if you go to your bank or use a mortgage broker. They're also offering sort of low doc, relatively efficiently accessible small business loans to help as well around the $250,000 mark. But again, go to your bank's website to see details around that. Underpinning all of this, of course, is the government, the central bank being the RBA, supporting the flow of liquidity and funds all throughout the economy to allow this to happen. One side note is interesting that's been discussed internally in our office is the industry super funds and whether they've got the liquidity to fund any withdrawals that are being allowed through the government changes of rules, but also people wanting to change their investments to cash or to withdraw money. So again, there'll be some interesting, the aftermath of all of this will be, I'm sure, rules around what industry funds can do in terms of liquidity, because they need to be liquid to get through these kinds of periods, and that's their job. Just going through this page, talking about government support of households. We've touched on a few of these already. JobKeeper payments. So if you remain employed through a business, the business will organise the JobKeeper payments for you. So just get in contact with your business. If you do lose your job, the JobKeeper payments will also be available via Centrelink. So just contact your local or online, typically through MyGov, to get that organised. I touched on in the previous slide this early release of superannuation. The details are still being yet to be provided, but the principle is that if you meet the conditions, which is basically that you've had a significant reduction in earnings, you'll be able to release $10,000 this financial year before June 30, and another 10,000 in post June 30 to help fund your way through this period. And there are other packages as well. Both the government is subsidising childcare for essential services and providing additional healthcare packages as well. Moving on to the West Australian government, they have probably the more significant items are that they're basically subsidising payroll tax for businesses with payroll between 1 and 4 million, and also reducing some household utility type payments. So they all together they help, but the main one is the JobKeeper payments, both either through the business or through Centrelink. We've got a slide here about should I take my money out of super. Look, the short answer is no. If you don't need to, you shouldn't. I mean, to go back a step, superannuation, just to remind people, is a legal entity, or it's basically a tax structure designed to save money in a very tax effective way for your retirement. So, I mean, it's really no difference to saying, should I take money out of my, tax effective savings account? Well, no, unless you really need to. And of course, if you need to, then you should. And that's why the government's allowing it. But superannuation is a wonderful vehicle that it allows people to save money, invest it appropriately with the help of advisors or sensible industry funds in a very tax effective way that grows your money so that you can hopefully be self-funded in retirement and not have to rely on the age pension. And that's the whole reason why the system was set up. The government wants people to be self-funded. You provide for your own retirement, and then for those who haven't been fortunate enough through life and careers, etc., then there'll be, an age pension that you can rely on. But that's really the base, the safety net. You really want more than the age pension to lead a fulfilling and nice, comfortable retirement. So, yeah, I mean, if you don't have to take the money out of super, then you probably shouldn't, because the money in there, as I said, it's a hugely tax advantaged environment. The most you'll ever pay in tax is 15 cents in the dollar in earnings or growth, compared to if you're out earning, investing money and generating profits, you could pay up to nearly 50 cents in the dollar personally. The compound effect of growing it in a sensible way with those tax savings means that if you take money, a bird in the hand is worth two in the bush applies here. Yes, $10,000 right here and now could be the difference between having a roof over your head, but if it's not that dire, taking the $10,000 out may cost you, based on these figures, if you took it out in your mid-20s, in 40 years' time, that $10,000 on moderate forecasting is worth $233,000 in 40 years' time at an average rate of return of 8%. So, yeah, that's what I would say about that. Look, that's probably enough from me. I think I've gone over time. Feel free, please reach out for any questions. We're at Financial Framework, and you can just email us or call us in. And also, if there's any questions now as well, I'd be happy to take any. Thank you.
Thanks so much, Dan. That was great. We have had a few questions come through. A lot of them are in a very similar vein. Is now a good time to invest more? And again, in similar vein, should I be salary sacrificing more?
Thank you. Good questions. And yeah, we've been getting, I've basically spent the last 4 or 5 weeks talking to people about these kinds of things. Yeah, I think it is a good time to invest, because really, the way to think about the stock market is like walking into a supermarket with lots of different businesses on the shelves, and they've got prices on them at any given moment in time during the course of a trading day. So to me, walking through the stock market, supermarket right now, everything's basically, it's like they put out the for sale sign and said, everything's 30% off what it was in January this year. So if you walked into a shop and they said, look, we've sliced 30% off all our stock that we had in January this year, you'd think, feels like it's a pretty good time to buy these things. And it's really no different in the stock market. I think it is a good time to invest, but the only thing I would say about that is you have to have at least a medium to a longer term horizon with your investment. So as I said earlier in the webinar, if you've got less than a 12-month or 1-year investment horizon, then I think I probably wouldn't invest in the stock market. I think there's probably too much volatility and too uncertainty about how long it'll take to recover. But I think if your investment horizon is 18 months, 2 years, 3 years and longer, it's actually going to, everyone look back in 2 or 3 years' time, go, that would have been a great time to invest my money, is my view. In terms of salary sacrificing into super, again, cash flow wise, if you can afford it, you've still got your job, you haven't had to take too much of a pay cut, and you're probably spending less money, actually, quite frankly. That's the one thing that people probably haven't quite factored into all this, is when you're stuck at home, your discretionary spend and your spend on entertainment goes down significantly as well. So there has been some saving there. But cash flow wise, if you can afford to sock away a few dollars, it's always a good time to salary sacrifice into superannuation, subject to not going over the maximum threshold and your taxable income. Now, and the reason why I say that is every time you send $1 through salary sacrifice to superannuation, assuming you earn more than, say, 40 or 50,000 taxable dollars per annum, you are saving significant tax on that dollar, because what you're saying is you're not going to get taxed at your personal rate of tax, you're going to get taxed a contributions tax, which is 15 cents on the dollar, much less than even the lowest marginal rate of tax, which is 20 cents on the dollar. So it's always a good idea to, in those circumstances, to salary sacrifice. Then the next question is, if salary sacrifice the money into super, how is that being invested? And that's a different question. So don't get me started on my bugbear or my hobby horse about how the industry funds invest the money, because a lot of them invest in, they call it a balanced investment portfolio, but it's actually very high growth. So it's almost all invested into things like the stock market. So the question is, you've salary sacrificed it into a super fund, how's it invested? And that will depend on your age and stage, appetite to risk, where we are in the economic investment cycle. So as I said previously, I do think it's a good time to invest into the stock market now, but that will depend on your individual circumstances.
Great, thank you. I think we'll just do one more question because we have run over time a little bit. And the question is it possible that the banks could collapse, and is my money safe with them?
That, funnily enough, was a very popular question during the GFC. Basically, the government introduced a bank guarantee. Hasn't been asked as much this time round, although talking to some other practitioners and experts that we deal with, a few people have been asking this question. The reality is your money is safe in any reputable financial institution. And when I mean reputable, I mean all the big banks or any, Macquarie Bank, the four main big banks, anything that's backed, and the government does guarantee any of these APRA licensed institutions. The reality is if any of these banks, it's a bit like the GFC, they're too big to fail. If any of these banks fell over, well, we'd have some serious issues. Even though, of course, you don't want to lose your money in the bank, but that would be a catastrophic systemic event in our economy. So no major financial institution is going to fail. Your money is safe in these types of institutions. Do not worry about it. There will be enough toilet paper for everyone. Don't worry about that. We're going to get through this. I know it's scary. I know it's uncertain, but really it's just a period of time, and people just need to keep doing what the government's telling us with the social distancing and keep your loved ones and the older members and the more health affected members of your family safe. Economically, we will get through this. The government's providing huge amount of stimulus. This will only last probably 6 to 12 months, and we will return to some normality.
That's great. That's a great note to end on as well, I think. So thank you so much for your time today, Dan. Thanks everyone for joining us, and we'll end the meeting now.
Thank you.